It is a pleasure to be back in Michigan, although I wish I had been back here last week for the turkey trot, which is an annual tradition for my family and me. It is also especially a treat to be back in Detroit with its rich
As you can see, we're watching the future, well, not futures, the live market actually right now, and we're seeing NASDAQ kind of jump up and down between a couple points here, and even the VIX is kind of going crazy, up and down, up and down. This is how it is. You have big speeches coming up. We also have the outlook for monetary policy speaking today, just to give us a view of what could be it's expected, because this week we do have jobs report numbers coming in, and if those are strong again, which I can guarantee we're going to get some questions asked. I already submitted my question on the Fed. Let's see where we're going with the basis points. It's like a lot of people don't like this Jerome Powell for doing his job, which I get it. He did want a slow track back to this 2% level of interest rates and all that. Kind of a smooth landing, but that's really hard to project. You have even positions of our own jobs you may have, or I have. There's decisions that you're in charge of that you make that can impact the business and your growth, as well as employees and unemployment in general. So those things need to be taken consider of. You can't just make a decision and not think it through and just stick to your gut and just hope for the best. You kind of have to weigh the options, and it seems like he's already done it too. He's kind of laid out a plan, a trajectory in that sense, and then modified it a bit. But it's like you make decisions when times are needed, and when you're not seeing numbers results, or the way you want them to go, well, then you make adjustments. And I think that's kind of what we've seen, but that's why you're seeing a lot of this uncertainty here in the live markets. 3 or 5 are down. S&P somehow has stayed around that. It's 43 to dropped a little 36, and it's But a lot of people are shooting for this 50, which he's not going to, obviously give all the information, but a lot of people are hoping December that we're going to get that 50. And I mean, even last time, it's like they did this decision. And he did choose the 75. We actually did see a big drop. August, same thing. Put the numbers out, and I think people were expecting a 50 then. It was a little too early. We have started to finally see a change in the market this time, but even recent reports as of Cyber Monday, I mean, it says that consumers are resilient. I mean, we just broke numbers for Cyber Monday online shopping. Even stores I know and businesses for Black Friday, they broke numbers. If you look at even the, second, even the second GDP was negative, and people thought that as well. And it seems to be that, there is some sort of resilience here, and just mentality of like not facing the reality here, in a way of, and a lot of people are denying this recession, which I believe we're already in when you have, layoffs happening, which was to be predicted as well. A lot of people knew that was coming. It's only a way to adjust what you're having to raise, because these interest rates that raise, it's costing them more money to borrow. We have, tariffs. It's costing you more money to buy. Same thing with interest rates. Everything's more expensive. You got to raise those prices up, and that's going to hurt the company's margins. So when you do that, you got to cut somewhere. And even Amazon yesterday, like they've done a great 15 out of 16 years of finding ways to get these products cheaper, same, or innovating with new, in general, just companies that are selling their products like to the consumer. Whether it be, different areas it's bought, third party, private selling, but they've done a job of doing that, and so far a good one, even though they're seeing some volatility as well. But yeah, when you have all this interest rate hikes like this, and like I said, tariffs, you got to find a place to cut to make your margins strong, and that's one of the ones. And a lot of people will look at this when we cut, jobs in a way and start doing layoffs. You tend to see even like when Netflix had a decline in subscribers, but that was also to be expected. That's why you saw a boost back on there. I mean, everyone's home. They're going to subscribe. They're bored. They need something to watch. Now they're back to work. I can't believe that many people are like, no, I'll cancel. It's not that expensive a month, but that kind of shows, where they're important when they're not. You did see a bounce back in them. You're seeing a bounce back in companies that are doing layoffs, because even though a layoff can look tremendously bad for a business, because if you're having to cut jobs and lay off, buying or paying people to make your product, in sense, it makes it look like you can't make your product or you don't have enough people buying it, with supply and demand factor. But reality is you can usually get roughly the same amount of work, and really you're taking that operating expense out. So in a way, you'll see, a actual increase in a stock at times when they do it. You'll see that first drop down, and then you'll see a boost back up because they know they'll be saving money, which by the quarter and by their EBITDA and their P&L, their own following standards to keep their company in line, they're doing what it needs to balance out their company. Same thing with the Fed. They're seeing all this money, which is going to increase job growth and wage growth, and it needs to slow, or all this supply and demand is going to be thrown off, and all these freedom of money, and they can buy whatever they want, in that sense, and there'll be no supply, shortage of supply, which could cause chaos in a way. So you have to kind of slow people down. But we still have a little bit, but you go ahead and start early because we have this outlook on the monetary policy, which I'm going to tune into her just a second and listen here.
lower productivity growth. The motor vehicle industry has mostly defied this trend of offshoring final production. The U.S. motor vehicle industry still produces more than 10 million vehicles per year and employs 1 million people at assembly plants, labs, and suppliers. Furthermore, it is an extremely innovative industry, and fierce competition forces automakers to roll out innovations quickly. As you know, dozens of motor vehicle R&D labs reside in Michigan alone.
We'll go back to the markets before he talks, because she's going through, in general, PPI, CPI, all the results and things and outlook of it. But we really want to know what Mr. Powell's going to say. So let's give it a little bit here. That's just a little intro.
and in sectors that are interest sensitive, especially housing, with residential investment contracting sharply. Consumer spending has remained resilient, however, supported by labor, income, and still elevated savings. As we said in the most recent effort,
If you heard where she's talking about elevated savings just now, it's a huge indicator that a lot of people are seeing where they're saying that the consumers are staying resilient. Because prior to this in 2018, which we also had a slight scare of a recession, same thing, people were looking at accounts, and you can actually look this up and see where, you know, the gross of the United States, and you know, a line of, you can see prices for housing and how they've dropped. You can see people's bank accounts, and not personal but savings, just in a clear sight of where they're trending up or down, because banks are allowed to release that data not on personal, but they can on, you know, and just overall numbers. And they can see that the savings accounts, obviously during the pandemic where there's quite a lot of money flooded in, they did see where, you know, people had that savings, it took a boost, and a lot of people actually didn't just go spend. They saved it, they invested it, they put it towards a new house, they paid off bills, they might have put it in the stock market and made a quick return, which is one of the highest ROIs we've ever seen of the year, especially if you were ahead of this game and ahead of trading, and you knew how to play the market, and you knew that seeing this much, you know, an influx of money and positivity, and, you know, Jay Powell kept talking and saying, no, I'm not going to do interest rates, we're still too unstable here with the pandemic, and we don't know about jobs, there's unemployment high, why would I start to do this when people aren't, you know, at work, they're working at home still. So yes, there was a lot of people at work, but there was still quite a bit of companies paying their employees to be at home and still working, still making the same money. And it was also one of the biggest years that we've seen a job shift. And when you have that many people that are unemployed or getting a bunch of money, well, if somebody just kept handing me $1,000 to $3,000 every couple of months, you know, I would want to be sitting at home a little bit, you know, I don't need to work. But that's not my mentality. I don't believe it's even 80% of the mentality of the U.S. I think it's just a small part that are like, oh, I don't need to work. And, you know, most of that's not to take blame. People were trying to stay safe. They're being mindful. They had, you know, quite a few news outlets they were listening for, and platforms, and they were, you know, balancing on, who do I trust here? What's going on? You know, when's this vaccine coming out? When can I take it? You know, all that in general. And when you're doing that, it starts to feel okay to be comfortable at home. And if you are still working from home, receiving this money, or even people that had kids, while they're receiving that, they can use it as a benefit. Others were less unfortunate, and that is unfortunate that there's a percentage of people that, you know, weren't so lucky to work through the whole pandemic, and a lot of those people did get money. There was also a delay in these payments, and which were caught up. You can check in the news. It's a fact check on that one. They were caught up. And I had personal friends that were submitting claims of being out of work and unemployment, and months would go by. I mean, it's kind of sad, but then again, you got to think you're telling even the government and, you know, people in the federal system to go home as well and work from home and try to, you know, yes, my sympathy's out there from all sides, from everyone's jobs, from everyone that we had to go through. But even I had friends that, same thing, they would submit a unemployment and all this stuff, and you didn't see anything, and it was months, 4 or 5 months to go by, and out of nowhere they would get a follow-up, and you'd see them receive a hefty check. And I think with the struggle of waiting and the struggle of, you know, anticipation on it, when they finally got it, they said, I've had to work my butt off here to keep this in line and try to find jobs that were hiring, that weren't just stay at home or weren't shut down. And now I have this money on top of it while I've also had to survive and make it through. And I think they just got a boost in money. Even last year we saw um, fair numbers, but now since everyone's back out, that's why you started to see travel go up this summer. People were itching to get out, and with prices, the fuel, which were moderately still cheap, they took advantage of it. But once that about November, and this is what we're waiting for today, is the outlook. That's the last one before he decides what he's going to do with this December rate hike. And at that time, in the past, before pretty much February, March hit, where he actually decided to, stick to his decision and follow through with it, that's when you saw the biggest decline that we've seen in a while. I mean, it took a couple months, but 3 months later, half your portfolio is 50%. Depending on how you trade, depending if you did diversify your portfolio, which I always say to do, and you weren't hefty in one sector, and the popular sectors were crypto and EVs as of 2020 and 2021. So we did see a lot of pain. But that's what we're trying to do today. We got a little bit left, and we're gonna listen in, and he's gonna give us hopefully some good questions, and they answer them, and doesn't try to change it up. He just sticks to it, because if it is needed, and we got to shake up the market, and we have to not do the 50 basis points, and we're gonna go headstrong and go straight to the 75 again. I don't think we'll go higher. Well, then, people are like, let's just get it over with and say bye to 2022, feel the bit of the recession we'll have in 2023, and hopefully by quarter two of 2023 we can start to hopefully see some change here, and a bit of a reverse, and kind of get back to that level of how much wage growth, how much money people are making with the price cost, and it balances out to slow them down, and you balance out that supply and demand. We'll go back to checking the markets here.
that it is a good thing that we have done this review and that we're paying attention to both sides of the dual mandate. It may not seem like it, but we are paying attention to both sides. We never stop thinking about one or the other. Our focus right now, though, is on inflation.
Understandably.
way it was set up. The Federal Reserve System was designed so that everything was not concentrated in Washington, D.C. and in New York. This is a national economy, and it has a lot of richness, a lot of richness. We learn a lot about oil from the Dallas Fed. We have the Center for Indian Country Development for the entire system at the Minneapolis Fed. So we have, each one has its specialty, and I'm glad that would be useful to become a Fed governor. Who knew? I mean, it's already a blessing and an
All right, we are about a couple minutes out, but if you guys know, not just that his jpowell's punctuality, but he tends to be sometimes like whenever I'm gonna come out. The last time we waited, it was live to go on. It was about 5-10 minutes he came out. Prior to that, it's like 30 minutes. So I'm hoping we can catch him here and at least like listen in and see if there's any strong questions we're getting where we'll see some answers. But I'm gonna pull this up. If you you're seeing lots of uncertainty and just I'm not gonna say so much chaos here, but we did see the NASDAQ drop and now it's back up 79 points. Dow Jones, that was up and it was headed down. Now it's down to 143 points down. Let's clear here. You'll see a live look at it. We're back and forth. I'm actually curious to see what the QQQ is doing. If you guys know about this, let's see. Okay. Actually, not bad. It dropped almost to 240, 250 a couple months back, and this is one of those. It's kind of like it's striving to be a, like the S&P, where it's got a bunch of companies that it's. I mean, it's nowhere close, but still, ETF that's got some strong tech. There's a little healthcare in there. It's the majority of it is technology. But still, this kind of goes hand in hand with the retail buyer or a retail investor here. And right now, I think that's why we're seeing the S&P so low. But there must be something stirring because everyone's kind of, we've seen a boost back here. NASDAQ's got somebody's got to be feeling good about something here, or they're just trying to position themselves, getting ready. I don't believe he's all the way ready. We'll chime in.
Price stability. We will not achieve a sustained period of strong labor market conditions that benefit all. We currently estimate that 12-month PCE inflation through October ran at 6.0%. While the October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear,
okay, now a lot of this we can actually just read. We can pull a PDF file off. What I really want to know is, the leading questions he's going to get asked and the guidance, because he does. It's coming up. It's December 14th, and we will know what he's going to decide. But this just we'll just keep chiming in here. There's only so much we can listen to here. Hold on.
Indicator of where overall inflation is heading. 12-month core PCE inflation stands at 5.0% in our October estimate, approximately where it stood last December when policy tightening was in its early stages. Over 2022, core inflation rose a few tenths above 5%, and it fell a few tenths below, but mainly it moved sideways. So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year.
Okay, see, there it is. That's one thing that's good that we're hearing, is that that's kind of what I've been projecting on a lot of the videos. If he's, this whole recession talks, and like I said, it's going to take time for these rate hikes, these interest rates to keep up to bring that inflation down. And that also goes with the jobs growth. But that was one of the answers, that he pretty much just said that, within the next year, which I've been projecting Q2 of 2023, we'll still be in that slight recession. But if he's saying by next year it could come up, and we'll, reduce the interest rates because of inflation falling, great. Now is where we would just be looking at this job growth and unemployment rate, which it's twice now been the strongest and didn't expect that to be so strong. Even with slight declines, they're expecting a lot bigger. Let's check.
Projections. I will return to policy at the end of my comments, but for now I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth.
Yeah, and if you guys heard earlier in the video, this is what I meant. It's the supply and demand. It works with everything. I've got a couple other videos about this where we talk about stock analysis and companies to trade in and when to buy. Well, it all revolves around supply and demand. He just pointed out there to what they're hoping to is to slow this demand down. That can catch up with the supply, because there is still supply chain shortages, even though we've seen some change in them, seen some better outlook. But yeah, his whole goal is to slow everything down until people could stop, which you heard it. I heard it earlier in the video and earlier in this. The more we see these, record-breaking Cyber Mondays and record-breaking Black Fridays, and GDP, even though fell twice in a row, people are resilient against this. It's kind of amazing. But let's jam back in here.
Not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into three component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn.
Which I can do. We all know what that was about, the housing. And it's almost like that was a clear sign of how everything else is going to work with houses, and how much before this there was so much supply. So many people had houses in the market. You could flip through whatever Redfin, whatever thing you want to look at, or platform to look for houses, and you could find deals left and right. Prices that were in line with what they should be at the time of rates. And then out of nowhere, same thing, you pump money into the economy, those houses start to, in that sense, mitigate, and they're gone. People are saying, wow, well, people are offering me whatever 20% above what I was even offering, just because they see shortages. And these people that are in businesses who actually make a living buying, fixing, and reselling, they knew this was up there. They were way ahead of it. And anybody who's in the real estate sector could just buy, because they knew they'd be profiting. I think the one thing is they didn't know how long this was going to go on. It did go on for quite a bit. And we've got 7 to 9, I think the last time we looked, is in a month for decline. With especially those rates, it went down to like 2%. You could get a house, and that was low. Even we didn't see anything above a 2% interest rate for a whole decade from the Fed almost. And then this is when we've seen the biggest one. That's why you will keep hearing it from me and from other people that yes, this is kind of like textbook recession talks. Even with the consumer and people being so almost against the reality, and that's okay. Every recession is not the same. You can't really go by the history, but that right there was the clear indicators that we saw in the past with the housing market, and how we're seeing it now, where it's just dropped, even though it's still high. A lot of them are still high, so they're still working on getting that down. That's why I still project these inflations, interest rates, and these estimated numbers to take so long. It's not just going to be overnight. He's trying to get a smooth landing. Let's feature back here.
For understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor force, in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic. Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely.
Okay, let's check the markets really quick. I want to see what's going on. He's talking about stuff we already know. You guys we should all know this stuff. If you're watching live or watching the recap, we already know this stuff. This is stuff that we've been over every month for the past, technically only 6 to 8 months, but a year leading into it. And NASDAQ's still strong. I mean, like, we're not going to see any kind of crazy volatility here or, unbalanced, because this isn't his decision. This is just an outlook. But I do think it's very important because most of the time people will lay out what they want to do. Now, with that being said, if in 2 weeks prior to this, where he actually releases the rate hedge decisions, that's where, we have that time of either a small rally if we get some good notes here, or could it be that we're going to run sideways because we don't really get much from it. Still waiting to see if he's going to get to the answer to some questions here. Like I said, I submitted a couple. I know there's always a lot, and they'll kind of pick and choose, but they're mainly going to come from the news because they get a kind of head start. There's the Dow Jones just went up. I don't know, that was completely reversed 10 minutes ago. So it's kind of funny that this is doing this, since all he's doing is recapping in a way.
Layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers. Given pandemic.
All of these reports, guys, by the way, you can find them literally online. You can see these things as he drops them by downloading the PDF, and it kind of helps me even read them ahead, even though I read this every day. You can see right there updated numbers.
Do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tool. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far,
Okay, that I don't like. We already had the numbers before, but that I don't like. Let's go see here, because that's still him pretty much saying that we have, this strong labor market and people, not like they're not returning, but that's going to give him more of a decision to do 75 points again and not 50. Even though it looks like right now, if we switch over, that people are still planning that maybe he's going to do a 50. But this happens every meeting. We think it's going to be finally back down to the 50, and sometimes he gives you a surprise. But let's get back in here.
are very modest so far relative to earlier increases, and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time.
Okay, that's the two. I'm almost going to call it. When the labor market's wage growth, and like he said, are strong, fine. But when he makes remarks like those where they're well above what they should be, those two things, money people are making, job growth, people not working, still having the money to buy, still increase in the CPI, PPI, and this inflation because of how much spending is going up, even though we've had 2 negative GDPs. That's like, I swear that's out of the, textbook of what the recession should be. It used to be a strong indicator, which could be, but it looks like now with those two things, those two indicators, I mean, we might want to, not saying cut this, but that could be, I don't know, let's check on the markets, because that could be it right there. Even though they're strong, which they could just be in line, maybe he's not pushing it too much to where it's going to be, a sheer fact in his decision making that he's going to, start to begin to be hawkish in a way. But so far, he doesn't sound dovish. I'll say that. Let's listen. There's the questions.
Thank you very much, Chair Powell. I think you spared me the chore of asking you to pick between 50 and 75, so I won't have to ask
That's
you that.
funny.
Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increase?
Let's check this really quick, because I was talking. Let's go back and look. Maybe that's why they're all holding. Give me 1 second, guys. I'm gonna go to the main, because they'll post this right away. Yep, there it is. Okay, we don't even need to. Yeah, we're good. He mentioned it right there while we were kind of analyzing that. He said, and it's possible this is just an outlook, but it's possible. We got it.
Important part of the
okay,
story
even with
forward,
those
particularly
strong
as it relates to that
numbers, even jobs growth, labor growth, wage growth,
core
he's saying it's not all,
services,
that matters, but he just said it. It's possible. Doesn't mean that's going to be our final answer, but it's possible that, he said that smaller rates in December could begin to start to happen. This is probably going to shoot up the markets. Let's look. This is probably going to do it. I'll give you guys a live look at
inflation
this
over
while
time,
he
making
just
basic
said that.
assumptions about productivity.
U.S.
And
markets, let's
so
get
if you look at the
a live
principal
look here.
wage measures that we
Oh,
look
yeah.
at, I would say that,
That could
you're
honestly be
1.5
really
or
good.
2% above that with current wage increases.
Yep.
So
And even if not, this is, like I said, this is going to give you your 2 weeks here
Employment compensation
of
index and
either
the
running sideways or
average
running
hourly
up.
earnings index. Look at those two. It's
I don't know about
about
you guys, but I'm
1.5%
pumped. That's
higher
actually, if he's saying that they
than
could,
what would be
fine.
consistent, making various
you hear
adjustments,
right there,
including
Fed
for
chair
productivity,
live right
for
away.
nominal wages.
That you should
So,
see tomorrow morning.
And as we look at the labor market today, including
that's
today's
probably gonna
JOLTS
be-
data, what you see
you're
is a
gonna
labor
see
market that
bit of
there's
an
a real
increase.
imbalance between supply and demand. There are 1.7
This could be a strong
job
rally.
openings for
It
every
could be just to
unemployed
lead
worker,
into, hopefully
everyone
we'll get our
looking for a
Christmas
job.
rallies here, and I'm not sure how long this is going to
so-called,
hold, but
jobs
I
workers
would
gap is about
take
4
advantage of this
million,
next 2
meaning
weeks.
If you look at
If he
all of the
does say,
available
hey,
jobs,
we're good to
including people
go
who
in
are working,
December
and look
and
at
claims on the
people who are in
14th,
the
we
labor
will
force
see a big
or
bump.
looking for a job,
And he could
it's a
reassess
4 million
next year.
shortfall. So,
But this could
you're
be
in
this
that
could be
world,
this is good
and,
news.
you know,
I don't
we
even
think,
think we need to listen
that
anymore. You guys can
there's a job for
catch it on
moderating
live if you want,
demand.
but that was all I needed. All right, we'll do another one soon.